Well, good morning, everybody.
Good morning.
It's Thursday, November 20th, and we're the Greater Victoria Real Estate Show. And who do we have here?
Hi, everybody. I'm Jane Johnston. I'm with the Briar Hill Group at Remax Camosun.
And Jen Lowe, mortgage broker with Dominion Lending Center's Modern Mortgage Group. Good to see you guys.
Good to see you guys. Okay.
Where are you from, Andrew?
What do you mean, where am I from?
You didn't introduce yourself.
Oh, well, people know me. I'm this guy. I'm just this guy, Yeah, so it's Andrew Plank, and I'm with Royal LePage, and been licensed since 2006, and we're just here to talk real estate and mortgages and all that good stuff. So
hold on a second.
Get into it.
We have congratulations for you first, because you got voted into the board.
Oh, yes. That's why we're doing this early today, actually, because I've got a board meeting at 9. Thank you. Yeah. So
Congrats.
newly minted director at the Victoria Real Estate Board again.
Yay.
Yeah.
Good for you.
Yay. Well, thanks, guys. Thanks for your support. I know Jen couldn't vote for me. She's not part of our organization, but I'm assuming Jane voted for me. I don't know.
I did vote for you.
You did?
Yes.
Yeah, thank you. Yeah, it's good times. Anyway, thanks for that, guys. Okay, so what are we talking about today? What's going on?
Let's talk about the biggest mortgage misconceptions of 2025. As we're coming to the end of the year, I thought I'd touch base on a few changes and break down a few of the myths that lots of people think are the way it is.
These are your biggest frequently asked questions that you get when you're talking to people?
Yes.
Okay.
Yeah.
This is good. Let's talk that. Do you want to do, Jen, an initial mortgage update in general, and then we'll get into the topic, or are we going to talk
Sure.
first?
Well, yeah, I might as well. I mean, there's not too much going on this week. Changes in interest rates really haven't. They're kind of around the same. We're seeing variable rates are now in those, high 3s, which is great. Yeah, we'll see. I mean, the bond yields are what determine the fixed rate. So we'll just kind of see if there's any changes there. But so far, this past week's been pretty boring, which is kind of nice.
Are we finding are we finding overall that it's better right now for longer term mortgages, or is it like a 3-year mortgage is a good thing? What's going on?
Yeah.
What's the best? Where's the best rates?
3-year fixed is better than a 5-year fixed right now. Yes. Yeah.
And
so they're betting that if you sign in for a 3-year fix, though, that on renewal you'll probably pay more than you would if you went 5-year all through? Or is that the bet that the banks are doing, or is that?
Yeah, that's the challenge, right? In that why are the banks offering a lower 3-year fixed?
Yeah.
Is it that they're expecting in 3 years rates are going to be higher? Right? So they'll get you, because they always unfortunately get us.
They do.
Right? They'll get you at the renewal in 3 years. So I mean, that's a bit of a concern, but really honestly, variable rates. What is nice is from a qualifying standpoint, I'm getting a little technical, but with variable rates, prime rate dropping to where it is now at 4.4, that's really helping with qualifying people that have lines of credit and stuff like that. It's making it easier from a qualifying standpoint for additional borrowing.
Yeah.
This is not boring information. This is good.
I was going to say that I think, mortgage brokers probably like boring, and realtors kind of thrive on a little bit of chaos. But would you say that's true?
100%. Yeah.
Well, so the other thing that I've noticed over the span of doing this, and something and Jane and Jen, maybe chime in here, but when, let's say, the 3-year rate is lower than the 5-year rate, and maybe you think even that rates will be you're better to go the 5-year rate, but you can actually qualify on the 3-year rate and maybe not on the 5 for what you want to buy.
Yeah.
And people maybe are concerned about, well, I'm going to get caught on renewal. It is hard to buy. It's hard. The thing is, for a first-time buyer, for a lot of buyers, it's hard to get your first home. It's hard to get to that point where you're qualified, where the amount you saved for your down payment is enough to get you in based on interest rates and prices of homes. So if you can get into that sweet spot of being able to buy, it's a really good idea most of the time to really consider doing that, because on renewal, that qualification isn't the same if you stay with that lender.
Right.
And yes, you might be paying more interest, but do you guys want to speak to that really brief before we go into the topic?
Well, and one other thing is, and I was just reading about this last night, actually. So people will quite often send me, I see that this, True North is one I'll just throw out there. The really low rates, 2.49 was the one that I was reading about online. What people don't know, and I don't work with True North. So I just say you need to do your research. If that's the route you want to go, you can work with them directly, but I don't work with them. But what a lot of the fine print with some of these really low rates that you will see is you're signing up for this low rate for the first 6 months or a year, and then you have to take a renewal term with them, and the rate is undetermined at this point in time.
Ooh.
Oh.
Yes. Or to get out of that, you're going to pay a 1% of the mortgage amount penalty.
Right.
On $1 million, 10,000?
Yeah,
10,000.
Yeah.
Yeah, so, like it always depends on what the terms and conditions are. When you're going to renew a mortgage, you're not just looking at the rate, you're looking at the terms and conditions, and you have to make sure that it all helps you in the long run, because you can really put yourself in a delicate situation.
Yeah, the fine print.
Yeah. Now the fine print piece, I remember this as a first-time buyer. And even on renewal, I didn't read the fine print of the mortgage document. I trusted my mortgage broker to, inform me if there was something going on there, because those mortgage documents are large, much more large and complicated than a real estate contract. And we always encourage our clients to read the real estate contract. Do you encourage your clients to read the mortgage documents in full? I mean, there's so much. I guess with real estate, we follow a common template, so any changes or deviations are really easy for us as realtors to advise our clients. Whereas I'm assuming every mortgage document from every company is very different. So how does somebody get in there and really read that fine print and just dissect it and understand it?
Well, I mean, it's up to them to read it, but I'm always going through the prepayment privileges and penalties. What would this cost you to break your mortgage? Because that is that's the big one that people don't realize, that, this rate is so good. Okay, well, it's great right now, but you're locking in for 5 years, or, and there could be a lot can happen in 5 years.
It would be great to have a spreadsheet that said, here's the initial rate, here are the monthly payments, here are the terms and conditions, so that you can compare, because they really need to compare apples to apples, right?
Yep.
Because if they're just looking at the rate, which is what people mostly look at, then they're putting themselves in a vulnerable position.
And then what's the norm 100%. Versus what's the exception? Because a lot of times, there is a lot, even in a real estate contract, there's a lot of really fine print that, if you could say, oh, well, that's kind of concerning, but there's a reason why it's there. It's consistent across all contracts. And it's not like you're dealing, again, with different companies. And there could be throwing a red herring in somewhere that you're not noticing on some of these other contracts. Whereas with real estate, again, because at least in Victoria, in BC, we've got some very prescribed documentation.
And it goes back to trusting your mortgage broker. I mean, I've got a lot of repeat clients that I've been working with for years, because I'm not putting them in mortgages that are going to cause them a major headache. And I'm making sure that they're aware of the fine print.
Yeah. Great.
But,
okay.
Yeah. So do we want to dive into some of the myths?
Of course we do. We absolutely do. Yeah.
All right.
Let's get there. And
well, let's go in. So I've kind of written out some myths or a lot of questions that I get from clients regularly. First one is you need 20% to buy a home.
Right.
And you don't. So you can buy a home with as little as 5% down for homes up to 500,000, 10% down on the portion from 500 to 999. However, we now have the ability to do an insured mortgage. So with less than that 20% down to a purchase price up to 1.5 million.
Yes.
Right. Yeah. We talked about that before. So, but the thing is, if you have an insured mortgage, you're paying a percentage for the insurance. And how much is that?
It depends on the amount that you put down. So if you put the minimum down, your premium, your CMHC premium is 4% of the mortgage amount. That gets added to the mortgage. So you don't have to come up with that out of pocket, but you are paying that premium.
So that's $40,000 on $1 million extra.
Yeah.
Okay.
Now,
what's another myth?
Yes. So, well, another one is, so we've got it on the page here, you can get a 30-year amortization with less than 20% down if you are a first-time home buyer.
That's a myth or that's a reality?
That's a reality. Pardon me.
Okay.
It's not a myth. That's a reality. Another myth. Yeah. So we've got the ability to go up to that 30-year amortization really increases your monthly affordability and your purchasing power.
So on $1 million, you have a 20-year amortization. What is that in a 5-year fixed? And what is it in a 30-year amortization?
Jen, you know that Jane's going to ask these questions, so.
And I don't, off the top of my head, I don't know exactly, but it's on average. I mean, I do these numbers all the time. It's on average $300 to $400 difference in the payment on a monthly basis.
On a monthly basis. Wow.
Yeah. So significant difference.
So the benefit is that having a 30-year amortization means that it can get you in the door, literally, and it'll get you in the door for maybe the first 3 to 5 years till your situation improves. Then you go to a 25 or 20-year amortization.
Right. Yeah.
Or is it better to do like like most people get 25-year amortization?
It depends on what their goals are. Right. I mean, if they want to, have the lowest payment, that is, people will go with a 30-year amortization. And quite often people have car payments.
Right.
People have other monthly obligations. So they do want the lowest payment. What I also advise as well is going in for that lowest payment as per your contract. But if you can afford to pay more, do that. Yeah. Pay the accelerated biweekly. Actually, one thing I dealt with this past week, a client, we had quite a discussion on the difference with accelerated biweekly or regular biweekly. So he's been paying on his mortgage regular biweekly payments and not gotten any benefit. And I was like, well, because he says biweekly, I'm paying biweekly. Yeah, but you're not taking advantage of that keyword accelerated. So you're not getting the benefit of paying biweekly.
Okay, so let's clear that myth up. What's the difference?
So the difference is the accelerated biweekly payment is exactly half of your monthly payment, and you are making one full extra mortgage payment each year.
But you're losing, you take off 4 years, right?
Yeah, you're taking off a significant amount in the lifetime of your mortgage.
By doing
because you're paying the principal off faster.
Yeah.
Okay, so accelerated biweekly is every 2 weeks.
Yeah.
And regular biweekly is every
it's
half
every
month?
2 weeks as well. Yeah.
Okay. So you're just paying less?
You're paying less.
You're paying less. Okay, you're paying less because it's assuming you're not paying exactly half of your mortgage.
Regular monthly
you're paying
payment.
1/31st times 2 weeks. Okay, got it. Yeah.
You're paying an extra payment per year. You're paying one extra payment.
Yeah.
Yeah. I think one of the things that, I mean, we all have a hard time, I think, with our self-discipline, but when it comes to making a mortgage, when you sign up for a mortgage, let's say you get in the States, they're talking now about 50-year mortgages. So I like to use extreme examples. You go with a really long-term mortgage, and the bank has agreed to let you have 100 years for your mortgage. And that means you'll be making payments forever for the 100 years until you're paid off. But you could pay extra, and you can pay it down, and you can pay off your mortgage in 10 years if you want to pay extra. The other side of that is if you get a 10-year mortgage, saying, well, I'm going to be able to pay off my mortgage in 10 years. I'll be paying that anyway. But then you have some financial difficulties, and you go to the bank and say, I need to skip a payment. Or not skip a payment, but lower my payment. They're not going to allow that.
No.
So you're better off, if you have the discipline, to give yourself the flexibility to go with a longer term mortgage, but make sure you make the payments as if you were on a shorter term mortgage.
Yeah.
So I have a question for that. So if you go with the longer term mortgage, which here, not many people go longer than 5 years on a term, even though it's amortized over 25 years. In the States, they would have a 25-year amortization and a 25-year term. So they would, unless they broke that mortgage or whatever. I don't know how they do that in the US. But so if it's better to go with a longer amortization, are you then able, if you do accelerated biweekly, are you going to pay off your principal? If you let's say you're on a payment plan where you're paying just like 1 or 2 extra payments per year, are you going to pay it off faster if you're in a longer amortization because you're going to actually get more of the principal paid off?
Yes. Really, honestly, yes, because the key piece is those additional payments are being applied to the principal directly.
Yeah.
And it's compounding interest, so it reduces faster.
It's like compounding negative interest. You're taking money off of what would have compounded.
Yeah.
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 Yeah. It's so funny, like how a little bit of knowledge, in a good way, doesn't get you into trouble. But I have a client who they were in a previous relationship. They always did one monthly payment. And I said, oh, why don't you do accelerated biweekly? And they're like, why would I do that? And I said, well, because over the course of 25 years, you're going to reduce your mortgage payments down 4 years. And they were like, oh my God.
Yeah.
Are you kidding me? Anyway, it makes such a difference in the long run.
Yeah.
Yeah.
Yeah,
no, it sure does.
Any other myths or misconceptions we want to talk about?
Diving into down payments a little bit.
Yeah.
So lots of people think, okay, they need to have saved up their full amount of a down payment. People can get a gift from family for a down payment. There's a first home savings account that you can utilize and take withdrawals out of. You can take money out of your RRSP without paying withholding tax if you're a first-time home buyer. The difference with the RSP and the first home savings account is the RSP, you have to pay it back to yourself.
Yeah. And is it 15 years to do that?
Yeah. Yes.
Yeah. So so you can save toward your down payment with your first time home buyers.
First home savings account.
First what is it called? FHSA. FHSA. And then you don't have to pay that back because you're basically, and it's tax free. And the other one is RRSP, and you have to pay back.
That's
right. So what it's done by doing that is they're allowing people to save for themselves tax free.
Mm-hmm.
Yeah, great. Yeah.
Now does that, now you have to start saving, you have to start that account in order to start building that space in that account, right? And the space that you can put into it grows every year, right?
You got it. Yeah.
So anybody listening to this who hasn't bought a home before should be going out and opening that account, even if they don't have a lot of money to put into it. Correct?
Yeah. Even if you're putting $25 a month, it adds up.
Yeah.
I'm wondering if maybe that's a better plan. Does it have to be used towards home?
The first home savings account?
Yeah.
Well, yeah. Yeah. If you take it out and it hasn't been used to a home, there's more than likely
There'd be tax will apply.
Yeah.
Yeah. Yeah. It's like an RSP, but specifically for a house is my understanding. But again, talk to your tax advisor, folks. Don't, we're not experts in this, but but my understanding is that
oh, sorry, go ahead. Go ahead.
Well, it's just that my understanding is that, again, the space that the amount of money you can put into it grows every year, because regardless of how much you put into it every year, there's an additional amount that you can put into it. So let's say you start that account when you're 18, but you're not making a lot of money and you're not even putting a lot of money into it. But then you start a new company and you have a windfall and you have a bunch of extra earnings. You can put at some point a lot more into that and then pull it out again tax-free for your purchase. Again, talk to your accountant. But if you start that account, the year before you're going to buy a house and think you can put a bunch of money into it, you can't, because you haven't compounded that. You haven't added,
and there's maximum
annually
amounts that you can put in.
That amount. Yeah.
Yeah.
Mm-hmm. I'm just thinking that's probably, how old do you have to be to start the first time home buyer savings?
I believe it's 18. Yeah.
Okay. Yeah, that's a great idea. It's a great idea as a parent, because you can only pay into RESPs for a certain amount of time. Then you can switch it over to a first time home buyers.
Yeah. Yeah. The key when we're looking at down payments is we're looking at the last 90 days. So we're looking at, for clients to be aware, we have to provide a 90-day history of any money that you want to use towards your down payment.
So you guys don't care what happened 91 days before, but if it's come in within the last 90 days, it has to be accounted for.
Yeah. Lenders do have the right. I mean, if there's some fishy stuff going on, they may come back and say, I want 6 months. There's a lot of cash deposits but.
I just want to say this really speaks to being careful in your planning when you're purchasing a home, and why you want to talk to people before you're actually ready to buy, because it's all about getting yourself prepared and getting those things in place before you make the decision. Because in one case, I know that I have a client who actually had to defer buying because they didn't have the money in for 90 days, and they had to go through a whole bunch of hoops to realize their purchase in time.
A lot of times people have the money, but it's in different accounts that they have to consolidate, or yes, there's some family money it's been promised to come their way. But when they find that property that is the one, the seller doesn't care that they don't have their money in hand, all consolidated and ready to go. It's the lender that needs it, and that seller is not going to be there in 90 days. That seller is going to have sold to somebody else.
Yeah.
So
I
get
always
your ducks in a row.
Too early. Yeah, it's never too early to reach out. People say, "Oh, I'm not looking for another year," or what have you. Well, we can definitely get the ball rolling now.
I think that's the refrain that we constantly, we hammer that message. I think we make that message quite often in this show. I think we talk to our clients about this as well, quite often, but what we don't necessarily see is we still have people who haven't talked to us who come out of the blue and say, hey, I'm ready to go. I've been thinking about this for a long time, and now I'm ready to go, and now I'm going to let you know. and then we're stuck kind of backpedaling as we help them realize that maybe there's more they have to do than they thought.
Right.
Yes. Yeah. So, get your ducks in a row before you buy the house. How do you get your ducks in a row? Meet with your mortgage broker and your realtor, probably like I would say 6 months to a year ahead of time.
Mm-hmm.
Yeah. And actually talk to your financial consultant too. Remember, we've just been talking about things like this first time home buyers account. Yeah. These different accounts and the different ways that you manage your finances, that can sometimes be years in the making. So always good to just start in the right direction early.
Mm-hmm. Mm-hmm.
Yeah. Anything else we want to talk about, guys? Any other myths?
No, I'm good.
Okay. Well, folks, if you have questions or you have something that was unclear to you when you got your mortgage and you want to know more, or you want to get some feedback, or you want us to put it out there for others to know, please, we've pre-recorded this one, but by all means, put something in the notes or send us a message and we will make sure it gets into a future episode.
Sounds great.
Okay.
Let's do the stats.
Oh yeah, stats. Okay, so let's get over to that. Stats. So I'll take this one. So this week we had 198 properties go live, 227 last week. So we're down a little bit week over week. We're weaker this week. I had to say that to make Jane laugh. 118 properties this week went to, oh my God.
Pending.
I know this, but I have to read it. My brain goes, I can't see it, therefore I don't know what it is. And there's a little overlay that tells me what slide we're on. So 118 pending versus 149 the week before. 114 price decreases this week versus 149 the week before. And 62 properties expired versus 57 the week before. Any comments on this, you guys?
Yes. So new listings were down, but we're also down on pendings. However, I did find this week to be quite busy in real estate, and I expect that number of pendings is going to go up week over week next week. So that's my anticipation. Also, in the past 2 weeks, we've seen pending and price decreases have been matching. So that's interesting. And expireds going up. I expect that next week and over the next coming weeks to go up as well.
Definitely. There'll be people taking their properties off market for winter, and not just renewing as well. But I think, yeah, we'll start to see some more expireds. Okay. Jane.
So our list to sale ratio is at 60%. This is for new listings coming on the market and pendings. And it is a kind of a not a real statistic, but it does tell us sort of where the market's trending. So we're just down 5% week over week.
Thank you.
Okay, net unconditional sales, we're at 119 so far for November of 2025 compared to 500.
Is that correct?
Let me check. Hold on a second.
Jane did the stats this week.
Okay, yeah, we are now resuming our recording. So net unconditional sales, so far we're at 225 for the month of November 2025. And new listings, we're at 437. That's compared to 802 for November last year. So we're doing pretty well on that.
Okay.
And then total listings, we're at 3,235. So we're down compared to last week. So that's good. And we're still
higher
up
than
over
the
last
month
month.
before. Yeah. Okay.
Yeah.
So ignore this slide. Jean gave the correct numbers verbally. We just had missed this slide on an update. So moving on there. On the heels of that gaffe, we want your feedback. How we doing? If you like what we're doing, please give us a like. And if you like what we're doing, please also subscribe so you don't miss any future episodes. And we always want to hear and communicate and have conversations. So please comment. And if you know somebody who is looking for this kind of information, please also share it with them. Share it out to your community. That would be really appreciated. So I'm Andrew Plank. This slide, I need to update these. The Vibe Collective is no longer for now until it gets refurbished from the ashes. We will, like the phoenix, it will rise again. But Andrew Plank, Personal Real Estate Corporation, I am with Royal LePage. And you can reach me directly at 250-360-6106. Email is info@andrewplank.com.
And I am with Modern Mortgage Group through Dominion Lending Centers. Jen Lowe, cell number 250-217-4925. Email is jen@jenlowe.ca and website is jenlowe.ca.
All right, and I'm Jane Johnston. I'm with the Briar Hill Group at RE/MAX Camosa. My number is 250-744-0775, and you can reach me at jane@briarhillgroup.com. And if you want to check out our listings, I'm at briarhillgroup.com, or you can reach me on Instagram at realtyteacher_RE/MAX_Victoria. What?
I want to say it's my turn now. Congratulations back to Jane for top 50 Canada-wide for her team.
Yes. Yeah, baby.
Top 50 RE/MAX. Yes.
Amazing.
RE/MAX.
Awesome.
Yes. So
well done.
We've been working hard this year.
I imagine. You work hard every year. Good for you. You deserve it.
Thank you.
Okay. So again, we're the Greater Victoria Real Estate Show, a group of colleagues and professionals who get together just to chat real estate and things of interest. And we are on every Thursday morning at 9:30. So please tune in.
All right. See you next week, guys.
See everybody. See you all next week. Okay. Thanks.
Bye, everyone.
Bye.
Bye, everyone.